Hey, what's up, everyone, and welcome to the School of Personal Finance. As we wrap up October here, the stock market, it's been pretty ugly. Matter of fact, it's been pretty ugly the last 3 months. So in this video, we'll talk about what's going on. We'll talk a little bit about the Magnificent Seven in the stock market, talk about the economy a little bit, about gold. I'll show you some charts, show you some resources that I use when looking at the markets, and try to wrap this all together, see if we can figure out what our next move is. All right, let's get to it. Real quick, head over to schoolofpersonalfinance.com, sign up for my newsletter. I'm sending out resources typically once a week. I'm also coming out with new programs, new courses that I'm going to be offering. Also, working with me one-on-one, creating your own financial plan. So go check all of that out. All right, so the markets, we're down about 10% from our most recent high, which was like the end of July. Now, 10% moves down in the market, those are called corrections, right? When the market is down 20% from a high, then we're considered to be in a bear market. So if we look at this chart real quick, this shows us the stock market pullbacks, the number of 10% corrections that investors had experienced in each of the last 43 years. And as we could see, out of the 43 years, in 24 of them, we have had at least one 10% pullback. So it is not uncommon for us to experience a 10% correction in the market during a year. Now, we could see there were some years where we had multiple 10% corrections during the year. But the point is, each one of these 10% corrections, they all did end up being a good opportunity to add money to the stock market. Some of them were much more painful than others. And as we could see, in the late 90s through the early 2000s, they were coming fast and furious. The market was very volatile, and we had big downturns in the market. Again, right around the Great Recession of 2008 through 2010 or so, where the market, really took a dive lower, and we did see a lot of 10% pullbacks during that time. But when we zoom out and we look at a larger scale, those ended up being good buying opportunities over the long term. So now is not a good time, not a reason to panic and want to sell all of your stock positions, especially when we're talking about saving for retirement. All right, now this chart, this shows the S&P 500 from the end of 2017 up until today. And we have the moving averages on this chart. So as we could see, this orange line is the 50-day moving average. So that's where the S&P 500 has averaged over the last 50 days. And then this red line is the 100-day, and the green line is the 200-day moving average. And now the blue line, this is the S&P 500. So as we could see on the chart here, the 50-day moving average just crossed below the 100-day moving average. And down here, the green one, this is the 200-day moving average, which is 4,251. And the market just recently, it dropped below there. So I'm making this video on Tuesday. So yesterday we had a big bump in the market, and we jumped up, a little bit over 1% that you see right here. So year to date, the market is still up 8.5%. But now people are worried. The fact that the S&P has dropped below the 200-day moving average, we want to see it get back up above that quickly. If we stay down here, we might try to get through this 200-day. And if we can't, if we get rejected, the market could resume this move lower. So we call this technical analysis. People look at charts and they try to predict the future and make assumptions for where the market is going to go. It's not an exact science. And a lot of times, these averages, they will dice right through these moving averages where there should be resistance, but they'll just fall right through them. So we'll see what happens going forward. Hopefully, the market seems very oversold right now. So hopefully we could get a nice rebound, a nice bounce over the next few weeks or so and get back above this 200-day and start to see the market bottom out and make a move higher. But again, nobody knows what's going to happen in the future. Now, if we look at these peaks in the market, so this was the end of July right here, and you could see we're down just about 10%. After yesterday, it's a little bit under 10% that we're down now since that high. If we go back to the top of the market, this was basically the beginning of 2022, January of 2022. The market had a big sell-off where we had more than a 20% turn down in the market. And then we had this nice rebound to start off 2023, and now we're giving it back. But the S&P 500, it's really only down a little bit more than 12% from this high at the end of 2021. So a lot of people are turning bearish out there, meaning they're becoming very negative on the market, but you can never go with the herd. A lot of times when everybody gets really negative, that could be the right time to start moving back into the market a little bit. We've had this 10% sell-off. It's happened fast and furious. It's been painful. So usually we don't have 4 months in a row of negative markets. It could happen, not to say that it never happens, but more than 3 months, it doesn't typically happen. So we're looking for a little bit of a rebound here in November, through the end of the year. And seasonality, usually November and December are good months for the stock market. So we'll see what happens. All right, and then this chart here, I thought this one was interesting. This is the performance of the Magnificent Seven. So you hear CNBC, everybody calling these 7 stocks the Magnificent Seven now, and they're made up of Meta, Amazon, Apple, Alphabet, Nvidia, Microsoft, and Tesla. And they've got beaten up over this last month. So this has come down a little bit. But if we look at the chart here, we could see that they are up 215% since the beginning of 2020, compared to the NASDAQ, which is up 43%, and the S&P 500, which is up 29%. But they are volatile. And who would have known that these 7 stocks would, have led the market higher? It's so hard to pick individual stocks, but there's definitely risk to doing this. So if we look, they had a nice big run up, and then at the market top in January of 2022, they sold off hard. So they went down almost 50% over the next year, and now they've been running up again. So in 2023, up 79%. So where they go from here, nobody knows, but there is a lot of money allocated to these 7 stocks. They're the biggest players in the indexes. So we all own these stocks one way or the other, either directly or indirectly through owning an S&P 500 fund or the triple Qs, all these index funds. These are typically the largest weighted stocks in those index funds. And they've been great. They've really propped up the market this entire year. Underlying these 7 stocks, below these 7 stocks, the market really has not performed very well, especially when we look at small and mid cap stocks. They really have not performed well over the last couple of years. But I thought it was interesting, this chart, just how these 7 stocks have really outperformed everything else year to date. And then this chart I wanted to show you real quick. This just shows how the economy, it has stayed strong. So this is the GDP growth over the last 6 quarters. And if we look to the left over here, we could see that the previous 5 quarters, we were going down. This was when we technically went negative, even though it wasn't considered a recession. But GDP, it has been coming down. And then this past quarter, it jumped up 4.9%. So the economy is resilient right now. We have a very strong labor market. The consumers are still spending, even though between me and you, it feels crappy out there. Everybody that I talk to, they are on a tight budget right now. I talk to a lot of self-employed people who own small businesses. They're saying that people are paying slower than ever, that it just feels like people don't have money right now, and life is expensive. So I posted the other day, I forgot, on LinkedIn or Facebook, with a chart just showing how net worth has been at an all-time high right now, including mine. Even though me and people in my age range, we really feel poorer than we've ever felt before. Like cash flow, month to month, our bills, everything just seems so high, the high interest rates. So it's interesting that GDP has been so strong, but my opinion is we are really going to see it come down as the Fed continues to keep these interest rates elevated. It really is starting to trickle through the economy. And I'm going to make a video on how these high interest rates, how I'm seeing it impact people's lives all around me, especially when we're looking at mortgage rates and the price of home ownership, cars, credit cards, all of that kind of stuff. So I do think that we're going to start to see this come down. And we could see personal consumption expenditures, that as well. That is the highest print that we've seen in the last 6 quarters, really all of these. Gross private domestic investment, government spending is down a little bit from a couple of quarters ago, and net exports. But the economy's strong right now, and I don't think that's a great thing as far as the Federal Reserve is concerned, because they want to keep interest rates high, and this kind of gives them permission to do so. But the uglier the market gets, the uglier that consumer spending gets. If we start to see people getting laid off, the job market starting to crack a little bit, we will see, the Fed hopefully at least permanently pause and then maybe pivot and start to lower interest rates. But we're just not there yet. All they keep preaching is higher for longer. So I think there's more pain to come in this economy. That doesn't necessarily mean that it's going to translate to the stock market. Sometimes the stock market, is out in front of that, and maybe this 10% correction that we just had is a part of that, and maybe we'll start to move back up again. But it does feel like things are weakening out there right now. All right, and then this last chart that I want to show you here is the price of gold compared to the total return of the S&P 500 index. So now this is from the peak of 2007. So we did have the Great Recession, right after that. So the market, obviously got clobbered there. We could see down 50% at the lows, and gold was doing well. So gold was outperforming. Then in 2016, 2017, the market has basically gone nowhere but up since then. So the S&P 500 has outperformed gold, pretty handily over that time. But now things could change. Cycles change. We have a lot of things going on in the world right now with the war in the Middle East, a lot of uncertainty, the debt this country's in. Gold could break out of this chart and move much higher. I always say, and again, none of this is investment advice. I don't know anything about you. But when I'm managing money for clients, I try to allocate at least 5% of portfolios to gold, to commodities, to hard assets, to things that will do well if we do go into recessions. If the debt does get out of control, I do want to have some allocation towards things that do well in those environments. And this chart with gold, it's hung in here for the last few years. So it could break out and reach new all-time highs in gold. All right, everyone, that's it for this one. I hope that you found it helpful. Please leave me a comment down below. Let me know if you like these charts that I've been using in my most recent videos. With this market, you can't time the market, so don't do anything crazy. Now is not the time to go running for the hills, especially after we've had a 10% correction, right? If anything, it's good. As I'm speaking, it's basically the last day of the month. Hopefully you have your payroll going into your 401k or your 403b, and you're adding money right now at these lower prices. But when we have sell-offs in the market, for your long-term money, you have to look at it like an opportunity, right? You're just continuing to add money. Don't panic sell once the market goes down. Yes, we could move much lower, but hopefully you don't need this money for many years until retirement. So when in doubt, zoom out, look at a long-term chart, stay invested. Don't do anything crazy. If you want to reallocate things, if you have money that you need in the next couple of years, then yeah, the stock market is not the great place to put it, right? We could get 5.5% on 6-month treasury bills right now. We have money market accounts that are paying a good rate of interest right now. So be smart, make good decisions, but keep the long term in mind. Don't panic and do anything crazy. All right, I will see you guys in the next video. Take care. Thanks.